Okay, I want to start this business basic video talking about forms of business ownership. It's important to understand the types of the basic types of business ownership. It's important in terms of your understanding about business and also your ability to understand the entrepreneurial process as well. So you need to understand that in making the business ownership decision, there are advantages and disadvantages to each type of business ownership, and there is a potentially an impact on your investment, impact on risk, also an impact on your strategic decision making as well. And finally, there are different methods to obtain ownership of existing types of business that we'll talk about briefly as well. Okay, so here's the impact, one of the impacts on ownership. Again, it has to do with the value of the firm. Is that your decision with respect to how you own the business may have an impact on your ability to access funds, on your ability to control the business, and on your ability to limit the amount of taxes that you pay, and all of those things have a direct impact on the value of the firm. There are three basic ownership forms: the sole proprietorship, partnership, and corporation. It's a good point to talk about this at this point. In most modern economies, this information will hold. The names might change slightly, but the sole proprietor, the partnership, and the corporation or limited company, if you're within the sort of British sort of system, are basically the same. Basically the same. Although if you're in any particular country, you need to just make sure and double check. But the basic concepts will be the same. The sole proprietor is certainly the most dominant or predominant type of business. It's owned by a single person. And the partnership is similar to a sole proprietorship, but it's owned by more than one person. And sometimes there's a licensure requirement, but sometimes there's a licensure requirement as well for a sole proprietorship. The corporation, which generally is a legal person, an individual, by act of the state, and is legally distinct from its owners as a result of that. And we'll get into more details of sole proprietorship, partnership, and the corporation coming up now. So a sole proprietor must accept full responsibility for the firm's performance. The profits are his or hers. The losses are also his or hers. There is no real distinction between the individual and the business. The business and the individual are one and the same. The basic advantages to sole proprietorship is easy to establish. It's easy to control. Obviously, it's you. It can be relatively private, since you don't have to make any public disclosures or statements other than your individual income tax. And then there's potentially tax advantages because you're able to reduce your income by certain expenses that you make on behalf of the business. The disadvantages is that there's unlimited liability, meaning any problem that exists in the business extends to you personally. There is limited funds, because the ability to get funds is limited to your personal credit and your personal ability to get funds. The business has a limited life. It's as long as you are running it or as long as you're alive. And all of these things together lead to increased personal and individual pressure. Next is the partnership. And there are a number of different types of partnerships. The two biggest and most common, the general partnership and the limited partnership. In the general partnership, you have partners that share in the responsibility of running it, share in the ownership, and also they share liability. For example, one individual in a partnership can incur debt that then becomes the responsibility of his or her other partners. Limited partnership is a little bit different in that there are partners that run the business, the active partners, and then there are passive business partners. Those are the ones that primarily invest the money, and they benefit on the profitability of the partnership, or they lose based on the loss of the business. But they are not involved in the management of this partnership, and as a result, they have limited liability, and their liability is limited to the amount that they invest. Okay. So again, general partnership, all partnerships have unlimited. All partners have unlimited liability. Limited partnerships, some partners have personal liability. Okay, that's limited to the cash or property they invested in the firm. These are generally called limited partners. The general partners, as I said before, the ones who manage the business, they may get a salary, they may get a share of profits, but they have unlimited liability. And the personal earnings received from a partnership are subject to personal income tax. That's because the partnership is a pass-through entity. It's not taxed. You're taxed as a partner based on your percentage ownership of the particular partnership. Just a side note, most venture capital firms, most private equity firms are set up as limited partnerships, where the investors invest, the pension funds and the insurance companies and those are limited partners. They invest money, and the general partners are those that run it, and they receive a fee for running it and also a share of the profits. So again, each partnership generally has a partnership agreement that governs how the partnership is run and how the profits and losses are split, in addition to how disputes are resolved, how the decision making goes, and again, how are the distributions as well as contributions expected. The advantage of partnerships. Relatively easy to establish. You have access to additional funds, other partners, obviously, being able to invest. Losses are shared. You don't bear all the responsibility for the losses. There's strength in numbers, just more than one person, as in the sole proprietorship. More specialization, meaning if you have more people involved, you can bring other sets of skills to the table. People can be more specialized in the activities that they are doing. And again, tax advantages potentially. Disadvantage is that control is shared. It's not just your business anymore. And for general partners, you have unlimited liability, both in terms of debt and in terms of legal liability. And what I mean by that is that debt in terms of financial, but legal, if the partner does something illegal, you might be liable to go to jail for that as well. Interpersonal problems, to the extent that that you're going to have to deal with your partners. And when people are in partnerships, sometimes they argue, sometimes they disagree. And profits are shared, which is potentially a disadvantage as well. Other forms of business, an S corporation, a B corporation, and a limited liability corporation. I just briefly want to mention these. We're going to talk about a corporation in a second, but an S corporation is a type of corporation that has fewer employees and fewer owners, and it is basically limited liability. So it has that part of the corporation, but it also is often taxed as a partnership, and so you kind of have the flexibility of having the advantages of both. A limited liability corporation is relatively new. Okay. Again, it has lots of the features of a general partnership, but it offers some limited liability for the partners. That obviously is a big deal. Limited liability corporations have really taken off because of that limited liability issue for the partners. The B corporation is something that's brand new. It's not really a legal form of business at the moment. There's been an organization that certifies companies that are following certain rules that are set up to solve social and environmental problems. And I would suspect that this type of business is going to become much bigger. Whether or not it's accepted and given special rights and rules in other countries is yet to be seen. But this B corporation is going to be something that we need to keep an eye on in the future, that we might be able to use it. Because again, these forms of ownership in large parts are tools that we can use as business owners, as entrepreneurs, as we go forward to build our particular business. Let me go back here. This just quickly shows that of the three types of businesses, sole proprietorship, partnerships, and corporations, that if you look on the left, the sole proprietors make up like 70% of all types of business. But if you look at the right, most of the revenue is attributed to corporations, and that just makes perfect sense, because corporations are the predominant type of business. If you're going to create a business, and I'm telling this to you as a advice, you should create a corporation because of the advantages that we're just about to go through. And in many states, in many countries, the cost of setting up a corporation is very, very small and negligible. However, in other countries, in Sweden, for example, it has been reduced from 100,000 to 50,000 in the last 2 years, but still 50,000 kroner is substantial. In the United States, if you create a company in, let's say, Delaware, which is the most popular state, it may cost you $100 or something like that. So you need to be aware of these costs when you are creating a company. So a corporation must file a document and file it with the state. Describes the name and the type of stock issued, how much stock is issued. It must have bylaws, which are kind of rules, but which govern the company. And in a corporation, the shareholders have limited liability. They're only liable again to their investment. And the shareholders elect representatives, and these are board members, and they are responsible for the running of the firm. It's ultimately the board's responsibility to hire the president and those that run the business on a daily basis. Okay. Now this is just real quick. There are lots of different types of stock that can be issued, and stock again represent ownership in the particular business. But here are two simple ways to look at it: common stock versus preferred stock. Common stock is, as you would expect, it's common, has full voting rights, it's eligible for cash and stock dividends, and has the last claim on distributed assets and profits if the business is dissolved. Preferred stock has minimum voting rights. It may have cash or stock dividends, but it has a higher claim in terms of dividends and assets. Okay. Oftentimes, preferred stock is granted a certain dividend, whether it be cash or stock, as a kind of, I wouldn't say guaranteed, but sort of guaranteed rate of return. And as a result as well, the preferred stock prices don't fluctuate as much as common stock. But common stock is the one that really represents the ownership in the business, especially because it has full voting rights. In many countries, preferred stock and different voting rights stock is very, very limited. Although in Sweden, for example, it's relatively common to have different classes of stocks with different voting types of voting rights. The advantage of a corporation, again, is limited liability, access to funds, whether it's funds on the private market or in the public market, which we'll talk about shortly. It's easy to transfer ownership just by selling the stock. And because the corporation has a life of its own, it goes on indefinitely. A partnership, we didn't mention. A partnership, technically, a general partnership, dissolves as soon as one person leaves. You have to reform a new partnership, and so that can be kind of cumbersome. Disadvantages is that there's organizational expenses to create the bylaws, the company, and follow the rules that are set by the state. Actually, there's a high cost to that. Financial disclosure, depending on the jurisdiction, you may have to disclose more of the financial dealings of the business. There's agency problems. What is agency problems? It means that those people that own the company are separate and distinct from the people who run the company, and so the people who run the company may have different interests than the people who own the company, and oftentimes a conflict there. And finally, this idea of double taxation. What it means is that the company, the corporation, makes a profit and has to pay a certain amount of tax. And then when the company distributes a dividend to the owners have to pay tax as well. So there is a double taxation challenge there. So this is the first part of the form of ownership. So let's take a quick break here, and I'll be back shortly.